Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading report for March 5th, 2016. So we have a market that's in sideways normal. On an annual basis, using weekly RSI 14, we're in just above the halfway point of neutral at 53 out of 100. On a 10-day basis with the 10-day NDX, we're overbought at 92 out of 100. Looking at the market mosaic price with respect to the 200-day moving average, you can see that we're in white sideways. The slope of the 50 is yellow neutral. ADX 14 has come back up to 15 with the bull slightly in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average. The threshold between risk on and off is 1.0. The current reading is at 1.159, so we're well into risk on. Taking that score and looking at the last 5,000 trading days, we can find the average and the standard deviation of that population and compute the risk Z, which right now is 1.77. Here's a 90-day histogram of that indicator. You can see that we had a move to +3 sigma, then -1, -1.5, -2, and then a generally improving market as volatility has continued to drain from the market, favoring careful measured entries on the long side with the possibilities of swing trading. And you'll see that that is what happened this week. In the blended monthly rebalancing, you can see the holdings for the month of April along with the current leaders based on price action as of the close on Friday. I would draw to your attention Latin America and Australia, which have been beaten down for almost a year, have moved to the top of the performance stack. And so from extreme conditions come extreme results, and we'll see that when we review the swing trade frames. The model portfolio in ETF2 stays at 70%, but the theoretical exposure moves up to 50% after spending a long time at zero. So we see that as long-term improvements inside the global markets. Making a note to myself to make sure that I look at those symbols. A little over half of the BMR 13 are now on buy signals, still led by treasuries, but you can see it's been given some back, and now you can see the real strength here in Latin America, Australia, and Asia less Japan. The interesting to note was that Asia less Japan was already a week into its outperformance last week. It was the second strongest symbol in the ETF2 model, so it continued to perform pretty well. U.S. small caps still remain on the bottom now, having with Latin America running to the front. In the ETF 32, again, about 2/3 are on buy signals. China, commodities, the Russell, European 350, all lagging. You can see Brazil has now moved up near the top. Gold is still kind of on a bit of a tear. Wondering if this resurgence in equities is going to affect gold, so we'll make sure that we take a look at that one. In ETF Max, tin, kind of remarkable. Metals and mining just had a continuous momentum this week. We saw that in last week's report. We put a swing trade on that one, so we'll take a look at that on the swing trade. Copper, Peru capped, Australia. So this is a rebound in the commodity areas that makes me wonder if energy and oil have really bottomed and are starting to climb out. So we'll take a look at those charts. Among the S&P 500, Freeport Moran, Continental Energy. Freeport Moran, as you would expect, when commodities and metals are really doing well. We'll take a look at Canadian Potash as well. Avago Technologies. Don't know, but I'll look at their charts. Look for second week momentums. Looking now at the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal lines, the purple ones, are price targets on the upside. Blue, we're in this negotiation channel here inside the 10. And then the red are the support levels that were once resistance, but once they broke through became support. This becomes our price targets on the way down. And the next price target on the way up is 203. And then the ultimate target up here at the all-time high, swing high around 211. It really has to get above and beyond that and close well for us to say that the bull is back. You can see the 10-period regression line and channel in the blue, steeply up for the last 10 days. The 30 had bottomed and now is above the 0 line. It is in positive territory, moving up now. You can see the time series of that slope of the 30 here, where it crossed the 0 line, where it bottomed out down here, and then improved steadily to cross the 0 line here, and is now up around 0.40. This is actually a very good 30-day performance. It's right at the threshold of 0.40 slope, which has been the edge of upward normal behavior. When it gets past a slope of 0.40, you're really getting into 30 days of significant outperformance. So this has really been a pretty good 30-day move from 187 to 201. 14 points. That's like an 8% move in 30 days. It's been a pretty good 30-day performance, which means that we've got to have systems that allow us to detect the difference between the steep down. Remember, this was down here, it was at minus 0.75, well beyond the minus 0.22 level of steep down. So we've got to find ways to distinguish between that and then this sideways chunking around in here when it's between 0.25 and 0. You can see how that slope was telling us things are getting better, getting better, getting better. And then when it starts to tip into outperformance, we've got to be ready for that. Now we're right on the edge of significant outperformance, but that's how I interpret this slope of the 30-period regression line is a very smooth indicator to give me a sense of what the next time frame trend is looking like. So we're on the boundaries of making a really nice move. So if we get some buying that gets kicked in when price crosses the 200 to the upside, it would not surprise me to see this continue on just on a technical basis up to 210. Interesting stuff. The ETF2 regional report, 5 of the 10 are on buy signals. That puts us from 0 invest 100% cash to improve now to 50% invested, 50% cash. It's cautiously optimistic. The S&P at 48 is still better than the globals of EFA at 44. Inside the U.S. it is large caps, then mid caps, which supplanted tech, followed third place by tech, and then the small caps. The two strongest sectors, kind of surprisingly here, ILF at 55 and EPP at 52, Asia less Japan. And maybe the part of that strength in Australia and the basic commodities. And then the two weakest, Latin American 350 at 43, and then the U.S. small caps at 42. So a real divergence there between the U.S. small caps and the large caps. Inside the S&P sectors, still consumer staples and utilities very strong, but technology starting to make a little bit of a move here, as is industrials. And I would expect XLB, even at 47, to be catching up based on the commodity prices. So I think there may be some room for that to still grow and catch up. That wants me to look at Alcoa and Caterpillar in the materials sector. World market model, all of the value plays in the U.S. are above average along with the S&P. The others are slightly below average. Gold, silver, treasuries, corporate bonds, and real estate all above average, especially strong in gold and treasuries. Malaysia, Indonesia have turned to be highly favorable. All the small countries favorable. Australia is out of the red. China's turning around slowly. Brazil really has leapt to the front of the pack. The rest of Latin America and emerging markets, Canada and Mexico, now are all ahead of the average of the U.S. right now. From the ETF2 lens, still the gold miners. This green and yellow metals and mining, that tells you just how exceptional that move was, that the short-term move has really pulled away from the 10-week moving average of that move. So we are very, very much still early in that move. Brazil, also green and yellow. You don't see that very often. Green and white for Malaysia and select dividends. Cooling off here in the treasuries, white and green, and high yield munis, white and green, is more evidence of a shift back towards risk on in the equities. In the Dow, leaders continue to lead. Verizon, Procter & Gamble, GE, Walmart, McDonald's, Johnson & Johnson, ExxonMobil moving to the top. Some steam coming out of Microsoft, white and yellow. Cisco, white and green for Microsoft. White and yellow for Cisco and IBM, says they may be the next tech wave. Some weakness in Home Depot, Visa, Intel. 5 now in the red for the Dow. American Express still lagging. Big smackdown in Goldman Sachs being red and white. There may be some overreaction in that one. So I'm going to look at ExxonMobil. I want to trim my Microsoft position. Shifting to the daily. Lots of overreaction signal systems here. And so this is one you're not surprised to see because of market conditions. This close to the 200 period moving average, this is one where I would not trade them mechanically. But if I did see weakness in them, like if this really was just a dead cat bounce off the bottom, it's had a really remarkable 30-day move and a 10-day move. So this would be a natural place for short-term traders to book some profits in this choppy zone around the 200. It's still a wide open political race, and don't know who's going to be setting policy. And so taking some off the table here would not be unusual behavior. So if we saw some weakness from that situation, then a momentum play to the downside wouldn't be far behind. And then under those conditions, these short positions make sense. But I would wait to see the evidence of failure before I tried to buck the trend of declining volatility and a retest of the 200-day moving average right now. In the Dow 30 Tactical, we have just a couple dojis. You see the overreactions. Nothing frames out well because of the close at or near the 10-day moving average. We got lots of good frogs involved here. You can see these in the green on the 1-day and the 10-day. This is where the relative strength is. And so DuPont, Apple, Caterpillar are certainly worth looking at as potential candidates for continued momentum. Same basic picture in the ETFs. Handful of dojis, tons of shorts. This is a market condition here, not individual signals, as I just explained. The VIX has been punished here lately. Treasuries, I would book those profits. And now we're seeing a rebound here in Brazil, Latin America, and oil. That, I think, is the place to really start exploiting. Winners in the auto framer and among the regression line fractals. Again, the top shelf is going to give you the deep value plays, and the ones in the red are going to show you the market leaders on the basis of how many ATRs they are ahead of their long-term fair value. So Verizon, 3M, need to add those two, because I would not be surprised to see continued momentum there. These are the daily squeezes, the ones that had a relatively small move on Friday but have large range stats. So if it does take out Friday's high, we could see a nice big a nice big one-day pop. I'll be looking at for Google and Amazon in this stack, and Disney and the real estate. Pardon my sneeze. 30-day regression line. You see the acceleration is to the upside with the polynomial regression here pulling away, looking good. This is why I like that slope stat as a way to find those turning points. Look how it did that here, and here, and up in here. 3 out of 3. Just entering the slope past 1 SD above the long-term average. The jaw is open to the upside here, and it coincides with that move. It's not predictive, but it is very descriptive, and it never surprises me when I see that kind of oscillation and that kind of clear guidance. Much easier to frame decisions off of these likely turning points because it smooths out that noise but catches the big moves. We're now back, 30 days ago we had the second worst 30-day slope stat of the last 10 years. That's how poor it was. And now it's already 1 SD above the long-term 10 period. We've got to be able to catch those kinds of turning points in markets that are oscillating within their trading ranges. It's been bouncing between 180 and 210 here for a while, and there have been up moves, down moves, up moves, down moves, and we've got to be able to adapt to that. This is how I tried to do that. I can work with an indicator like this. See, the volatility has pulled all the way back now to the long-term average. Just slightly below after being 2 SDs of noise. I'm going to flash through the stats here real quick. I'm going to be presenting some information to this online swing trade workshop members about a thing I'm calling the swing stat, which is a way to more formally structure the ideas about the slopes of performance over different time frames. So you guys in the workshop will have that to look forward to. Quite a change in the slope stats of the swing trade Z-scores, these different holding periods. Very nice layout here. Now the 30 has turned, has left the 1.0 SD river, if you will. The 90 has bottomed at -2 SDs, starting to slope up. The 10 has had those higher lows in its slope and is now still facing up, so I still think there's more squeeze left in the juice, but now we're getting ready to come into this congestion zone. The market flew through this period here pretty nicely and have made a decisive move out of the river. That's everything that I wanted to cover for tonight, and these are the charts that I'm going to be looking at tonight with the online swing trade workshop folks. And if there's enough interest in this, I could be convinced that this could be a subscription service. The swings really paid off well this week, as we're about to see in our next webinar. So it's Ken Long from Tortoise Capital. Keep your risk measured and your powder dry, and we'll see you in the chat room.